Your money could be in danger right now, and you don't even know it. Not because of an imminent economic crisis, not because of some market collapse, but for something much more subtle and much more dangerous. Something that Stanley Druckenmiller identified decades ago, and that continues to silently destroy assets every day. Stanley Druckenmiller is one of the most successful investors in modern history. During 30 consecutive years of managing billions of dollars, he never had a single year with a negative return. Think about it. 30 years, 0 negative years. Went through the dot-com crisis in 2000. It went through the financial crisis of 2008. It went through dozens of events that destroyed wallets around the world. And he always ended the year with more money than he started with. How is this possible? The answer lies in 3 specific signs that Druckenmiller learned to identify and that most people completely ignore. 3 invisible vulnerabilities that erode assets slowly but relentlessly. And the scary thing is that you probably have at least one of these vulnerabilities right now without having a clue. Before revealing what these 3 signs are, I need you to understand something fundamental. The biggest difference between investors who preserve capital for decades and those who lose everything in unexpected events is not the amount of information they have. It lies in the ability to identify vulnerabilities before they turn into real losses. Druckenmiller spent 40 years perfecting this skill, and what he found goes against just about everything you hear about asset protection. Here's the first thing most people believe that is completely wrong. Most think that financial vulnerability means having little money, that the problem is quantity. More money, less vulnerable. Less money, more vulnerable. Makes sense, right? Wrong. Completely wrong. Druckenmiller documented in his market analyses between 1986 and 2011 that some of the biggest wealth losses in history happened to people who had a lot of money. Millions of dollars, tens of millions, and in a matter of months, sometimes weeks, they saw everything evaporate. Meanwhile, people with much smaller but differently structured assets have gone through the same crises practically unscathed. Quantity is not protection. Quantity without structure is an illusion of security. And this illusion is the first trap. Here's another popular belief that data completely destroys. Many people believe that diversification is the definitive solution. Spread your money across several investments, and that's it. You're protected. Warren Buffett says, diversify. Ray Dalio says, diversify. Every financial advisor on the planet says diversify. So it must be right, right? Not so fast. Druckenmiller has a very specific position on this that surprises most people. He said verbatim in an interview with Bloomberg in 2015 that excessive diversification can be as dangerous as lack of diversification. Why? Because when you diversify too much, you dilute your best insights and leave yourself exposed to everything. When everything falls together, as happened in 2008, your supposed diversification doesn't protect you at all. A study published in the Journal of Portfolio Management in 2019 analyzed more than 5,000 portfolios during the 2008 financial crisis. Do you know what they discovered? Portfolios with more than 20 different positions did not have significantly better protection than portfolios with 10 well-chosen positions. In some cases, they performed worse because investors were unable to adequately monitor all positions and react when necessary. So if quantity of money is not protection and traditional diversification is not a guarantee either, what really protects? This is where we start to get into the 3 signs that Druckenmiller identified. But first, I need you to do something important. If you are the type of person who makes financial decisions based on verifiable data and not on guesswork or fads, you need to be subscribed to this channel right now. Everything I share here is supported by institutions such as the Federal Reserve, Journal of Finance, National Bureau of Economic Research. They are not opinions. These are historical data analyses that you can check. Press subscribe, because over the next few weeks, I'm going to reveal other principles that most people never learn, and you won't want to miss it. Now let's go to the first sign. The first sign that your money is vulnerable is something Druckenmiller calls the absence of asymmetry. This term sounds technical, but the concept is simple and brutal. Asymmetry means you have more to gain than to lose. Absence of asymmetry means you are in positions where you can lose as much as you can win. Or worse, you can lose more than you can win. Let me give you a concrete example that will make this crystal clear. Imagine you put $10,000 into a stock that is at $40. His optimistic scenario is for the stock to reach $60. Potential gain of 50%. $5,000. Your worst-case scenario is the stock drops to $20. Potential loss of 50%. $5,000. This is symmetry. You can win $5,000 or lose $5,000. 1-to-1. Now imagine a different situation. You put the same $10,000 in a stock that is at $10, and your analysis shows the potential for it to reach $40. 300% gain. $30,000. But even in a realistic worst-case scenario, you don't see the stock going below $6. Maximum loss of 40%. $4,000. This is asymmetry. You can win $30,000 or lose $4,000. 7-to-1 in your favor. Druckenmiller built his entire career on this principle. In a documented interview with the CFA Foundation in 2013, he explained that he never enters a position unless he sees at least a 3-to-1 asymmetry. $3 of potential gain for every dollar of potential loss. And when you find opportunities at 5-to-1 or more, that's when you dramatically increase your position size. Here's the problem. Most people never calculate this, never. They buy investments because someone recommended them, because it's fashionable, because it went up a lot recently, because everyone is buying. But they never sit down and do simple math. How much can I realistically win versus how much can I realistically lose? And when you don't do this math, you end up having a portfolio full of symmetrical positions, or worse, positions with negative asymmetry, positions where you can lose more than you can win. And then, when a crisis comes, when a correction comes, when any unexpected event comes, you have no protection cushion. You bleed the same or more than the market. Here's the data that should scare you. A Morningstar study analyzing portfolios of individual investors between 2005 and 2020 found that the average person had negative asymmetric exposure without knowing it. I had more positions where the potential for loss exceeded the potential for gain than the other way around. Why? Because they bought things that had already risen a lot, close to historical peaks, where the potential for a fall was much greater than the potential for a further rise. Now, the question you need to ask yourself right now is an honest and perhaps uncomfortable one. Do you know the asymmetry of each position in your portfolio? Can you tell me now what your maximum potential for gain versus your maximum potential for loss on each investment you have? If the answer is no, you are flying blind. And flying blind in financial markets is the surest recipe for losing money over time. Let's go to the second sign. And this one is even more subtle and even more dangerous. Druckenmiller calls this the absence of predefined exit triggers. Again, it sounds technical, but the concept is simple. An exit trigger is a rule you set before entering any position that tells you exactly what conditions you will exit under, regardless of how you feel emotionally at that moment. Why is this so important? Because behavioral finance research over the past 3 decades has proven beyond any doubt that human beings are terrible at making rational decisions when they're losing money. We have cognitive bias called loss aversion, which was documented by Daniel Kahneman and Amos Tversky, who won the Nobel Prize in economics for this work. Loss aversion means that the pain of losing $100 is psychologically about twice as intense as the pleasure of gaining $100. This creates specific destructive behavior. When we are making money, we sell too soon because we are afraid of losing the gains. When we are losing money, we hold on too long because we don't want to accept the loss as real. This behavior has a name: disposition effect. It was documented in a massive study published in the Journal of Finance in 1998, analyzing trades from more than 10,000 individual investors. The researchers found that investors sold winning stocks 50% faster than losing stocks. They cut the gains and let the losses run. Exactly the opposite of what they should do. Druckenmiller learned this early in his career working with George Soros. Soros had absolute rule. When you are wrong, get out quickly. It doesn't matter how much it hurts. It doesn't matter how much you believe it will reverse. If the data shows that your thesis was wrong, you cut the position immediately and move for the next opportunity. That discipline saved Druckenmiller dozens of times over 4 decades. Here is a concrete example of how this works in practice. You buy a stock at $50 because your analysis shows it should be worth $70. Before buying, you define a rule. If the stock drops to $45, $5 below your entry price, you automatically sell. No exceptions. No, I'll wait just a little longer. No, I'm sure it will come back up. You sell. 10% loss. $5 per share. Does it hurt? Yes, but it is a controlled, small, manageable loss. Now imagine you don't have this rule. The stock drops to 45. You think, it's just temporary. Drops to 40. Now it's too cheap. Drops to 35. Impossible to fall any further. Drops to 30. I'll hope to get back to at least my entry price. And suddenly, you're at a 40% loss. $20 a share. And now, psychologically, it is almost impossible to sell because the loss seems too big to accept. Quick experiment. I want to map out where the people who think mathematically about money are. Write your city in the comments. Miami, New York, Los Angeles, Chicago, Dallas, Houston, Atlanta, Phoenix, Bogota, Mexico City, Buenos Aires, Santiago, Lima, Medellin, Montevideo, or wherever you are. Genuinely curious about the geographic distribution of those who value rigorous analysis. This second sign, the absence of exit triggers, is responsible for more asset destruction than practically any other factor. A Dalbar study published in 2020, analyzing 3 decades of investor behavior, showed that the average investor in equity funds had an annual return of just 3.9%, while the S&P 500 index had a return of 10.2% in the same period. Why this brutal difference? It's not because investors chose bad funds, it's because they bought high and sold low. They entered when the market was rising and everyone was optimistic, and they left when the market was falling and everyone was panicking. They did exactly the opposite of what they were supposed to do, and this happens because they did not have predefined rules based on data. They made decisions based on emotion. Druckenmiller has a famous quote about this. He said in a lecture at Duke University in 2015 that the difference between amateurs and professionals is not in getting more right. It's in how you deal with mistakes. Amateurs deny mistakes and let small losses turn into big losses. Professionals accept mistakes quickly, cut positions, and move on to the next opportunity while keeping capital intact for the next big move. Now, ask yourself this question with brutal honesty. Do you have exit triggers defined for each position you hold? Do you know exactly at what point you will sell if things don't go as planned? If the answer is no, you are operating without a safety net. And when it falls, and you will fall eventually because every investor falls, the fall will hurt a lot more than it should. We reached the third sign, and this is the most counterintuitive of all. Druckenmiller calls this a lack of concentration on the best ideas. Wait, concentration? But didn't we just say that excessive diversification is a problem? Now, you're saying that lack of concentration is also a problem? How does this make sense? It makes perfect sense, and here's why. The problem is not diversification per se. The problem is dumb diversification versus smart diversification. Dumb diversification is when you spread your money evenly across 20 or 30 or 50 different things without any real conviction about any of them. You are diversified, but you are diluted. Your best ideas represent the same percentage as your worst ideas. That doesn't make any sense. Smart diversification is when you have maybe 8 to 12 positions, but your 3 best ideas, the ones where you did deeper analysis, where you identified greater asymmetry, where you have greater conviction, those 3 represent 50 or 60% of your portfolio. The rest is spread among secondary ideas that provide diversification, but don't dilute your best bets. Druckenmiller has always operated like this. In an interview with CNBC in 2018, he explained that when he had real conviction about an asymmetric opportunity, he concentrated. It was not uncommon to have 20 or 30% of the fund in a single position when the skewness was 5 or 10 to 1 in favor. And this concentration on the best ideas was what generated the extraordinary returns. Here is the data that will shock you. A study published in the Review of Financial Studies in 2017 analyzed the portfolios of professional managers for 15 years. He divided the managers into 2 groups. Group 1 had portfolios concentrated with an average of 15 positions, with the 5 largest representing 60% of the total. Group 2 had diversified portfolios with an average of 50 positions distributed relatively evenly. Result? Concentrated group had an average annual return of 11.7%. Diversified group had an average annual return of 8.3%. Difference of 3.4 percentage points annually. Does it seem like little? In 20 years, $100,000 in the concentrated group turned into $840,000. In the diverse group, there were $490,000, almost half. Why? Because concentration on the best ideas multiplies gains, while excessive diversification mediocrities results. But here's the crucial part that most people miss. Concentration only works if the first 2 signs are resolved. You can only concentrate if you have clear asymmetry in your favor. And you can only concentrate if you have defined exit triggers that take you out of the position if your thesis is wrong. Concentrating without asymmetry is betting. Concentrating without exit triggers is financial suicide. This is why these 3 signals work together as an integrated system. Asymmetry tells you where to focus. Exit triggers protect you when you make a mistake. Concentration multiplies gains when you get it right. The 3 together create what Druckenmiller calls asymmetric risk management. You structure positions where you can gain a lot and lose little. Define exactly when you will cut losses, and concentrate capital on the best opportunities. Now comes the part that truly separates those who will apply this from those who will just agree intellectually and do nothing. Implementing these 3 principles requires real work. It is not passive. It's not buying an ETF and forgetting about it. It is active in the sense that it requires analysis, discipline, and consistent decision-making. If what I've shown you so far is making sense to you, think of a person you know who is making financial decisions based on intuition rather than data. Someone who has never calculated asymmetry, which has no exit triggers, which has a super diversified but super diluted portfolio. Share this video with that person. It could be the most valuable gift you give her this year. Let's now move on to the more practical part. How do you identify if you have these three vulnerabilities? I will give you a specific checklist that you can use today. Get your latest investment statement. It could be a broker, a bank, where you keep your money. Look at each position individually. For each position, ask 3 questions. First question: what is my maximum realistic potential for gain versus my maximum realistic potential for loss? If you can't answer this with specific numbers, you don't have clear asymmetry. Vulnerability 1 identified. Second question: at what exact point will I sell this position if things don't go as planned? What's my number? If you don't have a specific number predefined before any emotional movement, you have no exit trigger. Vulnerability 2 identified. Third question: does this position reflect my conviction, or is it just there for diversification? If you have 20 positions and they all represent an equal 5% of the portfolio, you are probably too diluted. Your 3 best ideas should represent 50% or more. If not, vulnerability 3 identified. Now, here's the hard part. If you have identified 1 or more of these vulnerabilities, and statistically speaking, you have probably identified at least 1, you have a decision to make. You can continue as you are, knowing now that your money is more vulnerable than it should be, or you can do the work of restructuring. Restructuring does not mean selling everything tomorrow. It means starting a methodical process. For every new position you open from now on, you apply the 3 principles. Calculates asymmetry. Set exit trigger before purchasing. Focus on ideas with greater conviction. Over time, your portfolio will transform from vulnerable to resilient. It took Druckenmiller years to master this system. He didn't wake up one day knowing how to manage asymmetric risk. It was trial and error. It took losing money a few times to learn. It was developing discipline over thousands of decisions. But once he internalized these principles, he became virtually impossible to defeat over time. One of the most famous cases was the bet against the pound sterling in September 1992. Druckenmiller worked with Soros at the Quantum Fund at the time. The analysis showed that the pound was unsustainably overvalued within the European exchange rate mechanism. The asymmetry was brutal. If they were right, they could make billions. If they were wrong, they would lose perhaps 200 or 300 million. 10 to 1 in favor. Extraordinary asymmetry. They defined clear exit trigger. If the Bank of England managed to defend the pound with interventions beyond a certain point, they would go out and accept a small loss. And they concentrated. They put $10 billion into the bet, 1/3 of the entire fund. Total conviction in the best ideas. The rest is history. On the 15th of September 1992, known as Black Wednesday, the Bank of England was unable to support the pound. It had to leave the fee mechanism. The pound has depreciated dramatically. Soros and Druckenmiller made over $1 billion in profit in a single day, the largest single trade in history to that date. But here's what no one talks about. If they were wrong, they would have left with a small loss because they had a defined trigger. The asymmetric risk management system allowed them to concentrate safely because they knew exactly when to cut if necessary. Without this system, even with the correct analysis, they would never have had the courage to concentrate so much. That is the profound lesson. It's not about predicting the future perfectly. Nobody does that. It's about structuring positions where you can be wrong and survive easily, and you can be right and multiply capital significantly. It's about asymmetry math, not crystal ball. Now I'm going to tell you something that could completely change how you think about asset protection. Most people protect assets by trying to avoid losses completely. They look for safe investments. They diversify as much as possible. They stay on fixed income, avoid volatility. and they end up with mediocre returns that barely beat inflation over decades. Druckenmiller protects assets in the opposite way. He accepts frequent small losses as a cost of doing business, but structure everything so that these small losses can never destroy significant capital. And when he gets it right, the gain is so asymmetric that it compensates for 10 or 20 previous small losses. He's not trying to get it right 80 or 90% of the time. You're trying to get 40 or 50% right, but with the math so much in your favor that even if you get less than half right, you still multiply your capital. Think of it like boxing. Bad boxers try not to get punched, become completely defensive. He doesn't take many punches, but he also doesn't win fights because he doesn't attack. A good boxer knows he's going to take some punches. Accept this, but it protects vital parts. And when he sees an opening, he attacks with everything. He takes 3 light punches, but scores a knockout. This is asymmetric risk management. Here are statistics that should make you rethink everything. Analysis by J.P. Morgan Asset Management, published in a report in 2021, showed that if you missed just the 10 best market days in the last 20 years, your total return would be reduced by more than 50%. The 10 best days. Approximately 5,000 trading days. Missing 0.2% of the days cuts your return in half. What does this mean? It means that being out of the market trying to avoid volatility is deadly dangerous. But being in the market without risk management is also dangerous. The solution is to always be on the market, but structured in an asymmetrical way. You don't try to predict the 10 best days. You simply make sure you are positioned to catch them when they come. And it ensures that when bad days come, your losses are limited by pre-defined exit triggers. Press like if the mathematical principles I demonstrated make logical sense to you. Use it as a personal marker that you watched content based on evidence, not empty promises. Only 3% of viewers like it. Be part of that 3% who value rigorous analysis. Let's now come to the point that few discuss, but which is absolutely critical. Implementing these principles has a real emotional cost. You will do deep analysis, identify clear asymmetry, enter a position with conviction, and then see that position fall 5 or 10% quickly. Your exit trigger will get you out with small loss. It will hurt. You will question whether you should have waited longer. And then worse, you'll see that same position rise 40% 2 weeks after you left. And it will look like you made a mistake. Your brain will scream that you should have held on. That exit triggers are nonsense, that you would have become rich if you hadn't sold it. Here's the brutal truth no one wants to hear. It will happen. Repeatedly. It is an inevitable part of the system. You will cut positions that would have worked later, but you will also cut positions that would have destroyed capital. And over hundreds of decisions, dozens of years, the mathematics of asymmetry works relentlessly in your favor. Druckenmiller said in an interview with Real Vision in 2019 that his ace rate RTO throughout his career was probably around 55%, just over half. But their winning positions gained on average 3 to 4 times as much as their losing positions lost. This asymmetry, replicated hundreds of times over decades, generated $12 billion of personal wealth. Now, the final and most important question. What do you do with this information? You have 3 options. Option 1, ignore everything I showed here. Keep doing what you've always done. Keeps all 3 vulnerabilities intact. Accept that at some point in the future, when an unexpected event occurs, your assets will suffer more than they should. Option 2, agree intellectually, but do not change behavior. You think, that makes sense, but never actually calculate asymmetry in your positions. Never actually defines exit triggers. Never really focuses on the best ideas. You know what is right, but you continue to do the wrong thing out of inertia. Option 3. Implement. Starts today. Take each position in your portfolio and ask the 3 questions. Calculates asymmetry. Defines triggers. Evaluates concentration. And in the next positions you open, you will already open them correctly structured. It takes time. It requires discipline. But over the years, it completely transforms your results. Statistically speaking, 80% of people will choose option 1 or 2. Only 20% will actually implement it. And within that 20%, half will give up after the first few small losses, because the emotional cost will seem greater than the mathematical benefit. That leaves 10% who persist. And that 10% eventually takes over the system and completely transforms your relationship with money. The question is simple. Will you be part of the 90% who know but don't do it? Or part of the 10% that implement and transform? The information is there. The data is verifiable. The principles have been tested for decades. Now, it just depends on you. I'll leave you with one last thought that Druckenmiller shared that captures everything we've discussed here. He said the biggest lesson he learned from George Soros was that it doesn't matter how smart you are or how much you know. The market can always teach you humility. The only real defense is to structure everything so that your worst ideas can never kill you, and your best ideas can never make you rich. Think about it. Your worst ideas can never kill you. As asymmetry and exit triggers. You only enter where you can lose little, and he cuts quickly when he's wrong. Your best ideas can make you rich. As concentration. You put real capital into opportunities with greater asymmetry and greater conviction. The entire system works together, creating the seemingly impossible. Capital protection combined with explosive capital growth. Do you want to know the secret of how Druckenmiller has never had a negative year in 30 years? It wasn't because he always got it right. It was because when he made a mistake, he lost little. And when he got it right, he won big. Simple math. Disciplined execution. Extraordinary result. The 3 signals we discuss here are the skeleton of this system. Absence of asymmetry, lack of exit triggers, lack of concentration on the best ideas. Correct all 3 and you change the game completely. If you've made it this far, you're different from most. Most abandon when content requires real thought. You stayed. This means something profound about how your brain works. You value depth. You seek to understand, not just consume. Sign up to continue this journey of data-driven analytics. Next week, I will reveal another mathematical principle that most never learn, and that can multiply your results over decades. This review is for educational purposes only. All content is based on verifiable historical data and mathematical principles documented by institutions such as the Federal Reserve, Journal of Finance, National Bureau of Economic Research, and peer-reviewed academic publications. Nothing presented here constitutes personalized financial advice or specific investment recommendations. Past performance does not guarantee future results. Financial markets involve inherent risk and uncertainty. Each person has a unique situation that requires individual analysis. Always consult certified financial professionals before making any investment decisions. The goal of this content is to share mathematical frameworks and historical principles for thinking about money, not to prescribe specific actions for individual situations.